A balance sheet can reveal truths the income statement hides. For Monde Nissin, the Philippine food manufacturer, those truths mark a transformation, one forged not by chance, but by two distinct financial cleanups. First came the years of corn write-downs. Billions of pesos in impairments struck goodwill, brands, and plant assets. Monde acknowledged that earlier optimism for its British meat alternative business had faded amid inflation, softening demand, and rising costs. Assets shrank, retained earnings dropped. Yet cash didn't leave the company. These were accounting corrections, not actual payments. Then came the second cleanup: cash-funded debt repayments. Operating cash flow and substantial cash holdings allowed Monde to pay down loans, trust receipts, and trade financing. Notably, Marlow Foods, corn's operating arm, settled 2.44 billion pesos in debt in mid-2025, leaving only 1.14 billion pesos by June 2026. The group's finance costs fell, liability shrank, risk eased. These were tangible moves, making the company safer and more resilient. Together, these parallel actions reshaped Monde Nissin, though not without short-term pain. Write-offs depressed reported earnings. The share price fell dramatically, disappointing investors. The business looked smaller on paper, but its financial posture steadily improved. Today, corn is no longer merely a shrinking asset. The protein segment delivered 7.38 billion pesos in first-half sales, 2.29 billion pesos in gross profit, and swung from losses to a positive core income. Supply chain fixes, price increases, and improved productivity drove gross margins higher. For the first time, corn contributed meaningfully to group profitability, supplying nearly 2/5 of Monde's increase in consolidated gross profit, despite representing less than 1/5 of sales. Still, Asia pays most of the bills. APAC branded food and beverage posted 36.91 billion pesos in sales, with biscuits and beverages leading growth. Gross margin expanded, and cost-driven improvements ensured continued profit. Wheat and palm oil supply visibility reduced input risk, even amid slower domestic growth and international disruption. The real breakthrough, however, is cash flow. Net cash from operations surged to 7.63 billion pesos, covering capex, reducing receivables, and supporting nearly 7.19 billion pesos in cash dividends. With less debt and lower finance costs, Monde has more freedom to reward shareholders. Dividends have risen steadily, offering a trailing yield of 5.6%. For investors, the question is whether this recovery is durable. Bears see modest organic sales growth at corn, rising marketing costs, and uncertain consumer trends. Bulls see dependable profits from Asia, corn's positive income, reduced debt, and room for further margin gains, especially since much of corn's asset-carrying value has already been written down. A company that once promised too much has, through hard cleanups and modest recovery, become a safer investment. Corn is transformed, smaller, but finally earning its keep. Monde's cash flow is dependable. Dividends are rising. The lessons are clear. Write-downs made the company smaller, repayments made it safer, and corn's return to profitability may unlock lasting value. The balance sheet's evolution and the disciplined use of cash tell a story of resilience. It's not a simple return to former glory, but a company rebuilt on more realistic foundations, capable of growing earnings and steadily rewarding those willing to share in the journey.